Kenya's banking sector, for years, it's been defined by ballooning profits even in the harshest of economic situations. Perhaps the reason why 43 commercial banks have so far opened shop in the country to scramble for the spoils.
As we speak today, a number of banks, I think, were already targeting to enter into the market. We already have the rep offices that have shown a lot of interest coming into the market, and they already are licensed to operate in the Kenyan market, only that they are not commercial banks. But that's a stepping stone to come into the market, which means that the market is attractive for external players, for example.
But if the closure of 3 banks over the last 9 months is anything to go by, then the sector may be headed to a round of consolidation.
These banks either amalgamate, either they merge, or they are acquired by bigger banks, which are then capable of being able to lend huge amounts of money without exposure that makes them incapable of going under in the event of default by the after massive borrowing.
Already, the government appears to be leading from the front, with National Treasury Cabinet Secretary hinting towards the fast-tracking of the merger of 3 state-owned lenders, namely National Bank of Kenya, Consolidated Bank and the Development Bank of Kenya. The government has a combined stake of 70.6% in National Bank, owns 100% of Consolidated Bank through various government institutions, and has an 89.3% stake in the Development Bank of Kenya, while TransCentury holds the remaining 10.7% stake. In his last budget speech, the Treasury CS proposed a sharp increase in banks' core capital to a minimum of 5 billion shillings by June 2018. However, with some banks being exposed by the latest challenges in the banking sector, Treasury says it will encourage voluntary mergers and acquisitions as a way of stabilizing the banking sector.
The governor of central bank should not wait until June 2018. It is time for these small banks, the banks that fall under the 5 billion threshold, to start giving timelines for complying with the requirement of raising 5 billion as their operating capital.
Jamii Bora Bank, Sidian Bank and Equatorial Commercial Bank are among lenders that resorted to this option last year. The year also saw Fountain Investment Program acquire 5% of Credit Bank with an option to increase the stake to over 50%. Jamii Bora Bank just announced a 1.2 billion shillings joint investment from 2 private equity firms, while Fidelity Bank got 1.9 billion shillings from Duet Private Equity as a strategic investor. The Kenya Bankers Association, however, believes the banking industry still has space for bigger, stronger players.
Sometimes towards the end of last year, Central Bank put in a moratorium on new licensing of financial institutions. For them to have put a moratorium, it means that there were actually already interest that was being shown. Most likely there were even applicants that were already applying to be licensed.
The mergers and acquisitions remains an option. KBR reckons that it isn't necessarily a silver bullet for the challenges facing Kenya's banking sector.
In Kenya, we have been able to do quite well in terms of facilitating the SMEs to be the growth engine of the economy. Now, the large institution may not be able to reach there because of the fact that these are small borrowers who require small funding.
At least 22 banks will be required to comply to the 5 billion shillings core capital requirement by June 2018. Just how many among them will manage remains the big question. Patrick Igunza, Monday Special.